You probably think of wealth as something that gets realized at the end. You build up a position, the price climbs, and at some point you sell, you take the money, you move on, you've won. That's the mental model most people carry: work, accumulate, sell, receive. It makes intuitive sense. It mirrors how most financial decisions in ordinary life actually work. You sell your car when you're done with it. You sell your house when you move. The transaction closes the loop. But there's a version of wealth, a fairly specific and structural version, where selling is not the end of the story, where selling is actually treated as something close to a mistake. Not always, not universally, but often enough that it shapes entire portfolios, entire family strategies, entire generations of financial decision-making. And once you understand why, you start to see assets differently, not as things with a price tag, as machines. Here's the assumption almost everyone makes, that selling is how wealth becomes real. You see a stock that's tripled. You see a property that's doubled. The natural instinct is to close the position, collect the gain, and move the money somewhere useful. That instinct isn't wrong. For most investors in most situations, it's completely reasonable. But at a certain scale, with certain asset types, certain holding periods, certain embedded gains, the calculation starts to shift. And the people who understand that shift often behave in ways that look strange from the outside. They hold when the logic says sell, they borrow when the instinct says liquidate, they restructure when the pressure says exit. And the reason isn't sentiment, it's not stubbornness, it's not irrationality. It's that they've done the math on what selling actually costs, and they've found something that most people don't calculate until it's too late. When you sell an appreciated asset, you don't receive the full gain. The government receives a portion of it. How large a portion depends on your jurisdiction, the holding period, your income level, and how the asset is classified. But in the United States, for example, long-term capital gains are currently taxed federally at up to 20% for high-income earners, with an additional 3.8% net investment income tax that can apply on top of that. Some states add their own layer on top of that. Run those numbers against a position with a very large unrealized gain, and the tax bill can be substantial. Not a rounding error, but a permanent, irreversible reduction in the capital base. Here's the word that matters: permanent. When you pay a tax on a sale, that capital is gone. It cannot compound. It cannot generate returns. It cannot be borrowed against. The compounding base shrinks the moment the transaction closes, and it never recovers that ground. This is the first thing that changes how certain wealthy owners think about selling. It's not that they love the asset, it's that they've calculated what the asset is worth inside its current structure. Still working, still compounding, still deferring the tax event, versus what it's worth after a sale. Sometimes that calculation still favors selling, sometimes it doesn't, but the calculation happens. In most ordinary investment thinking, it doesn't. You don't think about the tax as a permanent subtraction from a compounding base. You think about it as a cost you pay to access your gain. The distinction sounds subtle. Over 30 years, it often isn't. So if the wealthy don't sell, how do they access money? This is the part most people haven't heard explained clearly. The answer involves something called asset-backed lending, borrowing against the value of appreciated assets rather than selling them. The mechanics are relatively straightforward. If you hold an asset, a securities portfolio, a piece of real estate, a stake in a private business, a lender may be willing to offer you a credit line secured by that asset. You receive liquidity. You pay interest on what you borrow. The asset stays in place, continues to generate income or appreciation, and the tax event is never triggered. In practice, this is used by private banking clients, family offices, and high net worth individuals to access spending power, fund new investments, or manage cash flow needs without ever formally selling the position. There are well-known versions of this: securities-backed loans, where a brokerage or bank lends against the value of a stock or bond portfolio; asset-backed credit lines, where the collateral is real estate or private equity; margin facilities, structured credit lines against diversified portfolios. The appeal is clear: you get liquidity without the tax event. The machine keeps running. But it's important to be precise here. Borrowing is not free. Interest must be paid. If the asset declines significantly, the lender may issue a margin call, demanding repayment or additional collateral quickly, at exactly the moment when asset values are down and options are limited. If interest rates rise sharply, the cost of carrying the debt increases. The strategy depends on the asset continuing to perform and the borrowing cost remaining manageable relative to what the asset earns. This is a tool with real risk. It works well in certain conditions and fails badly in others. It requires careful management, often with professional advisors. What it is not is a magic workaround. It is a trade-off: liquidity now in exchange for carrying debt and accepting the risk that conditions change. Wealthy families who use this strategy understand those risks. They manage them actively. They don't treat the loan as free money. But when the conditions are right, the structure allows something ordinary investors rarely have: spending power that doesn't require ending ownership. Not all assets are equal in this framework. A stock that pays no dividend and produces no income is different from a stock that generates a reliable quarterly payment. A vacant lot is different from an apartment building producing rent. A startup stake is different from a stake in a private company generating consistent annual distributions. The reason this matters is that cash-flowing assets are doing two things at once. They are appreciating in value over time, and they are producing income right now. That income can fund borrowing costs. It can fund operations. It can fund new investments. It creates a kind of internal momentum that non-income producing assets don't have. Think about infrastructure assets as a category: toll roads, utility networks, cell tower portfolios, logistics facilities. These assets tend to generate predictable revenue regardless of what equity markets are doing. They may also appreciate as replacement costs rise, regulation changes, or demand grows. And they can serve as collateral for lending at the same time. For an owner who holds an asset like this, selling it means giving up all three streams simultaneously: the income, the appreciation potential, and the borrowing power. What they receive in return is cash, which immediately faces taxation, and which, once spent or reinvested, no longer carries the structural advantages the original asset did. That's why certain wealthy owners don't even seriously engage with acquisition offers on assets like these. The offer price gets compared not to what they paid, but to what the asset would continue to do if they kept it. In many cases, the math favors keeping. Once you start thinking about assets as machines rather than price tags, a more complex picture starts to emerge. Each asset in a sophisticated portfolio is not just contributing its own return. It's contributing its collateral value, its ability to secure credit that funds other acquisitions, other investments, other structures. Think of it this way: a commercial property earns rental income, but it also supports a credit facility that funds the acquisition of another property. That second property earns income and also supports its own credit line. The assets are not a pile sitting next to each other. They're a lattice, each one bearing some of the structural weight of the others, each one enabling moves the others couldn't make alone. This is why removing one asset from the structure is not simply losing that asset's contribution. It can weaken the credit capacity, the borrowing base, and the optionality of everything connected to it. Sophisticated wealth management thinks in terms of this architecture. The question is not just, what is this worth, but what does this enable? The collateral value of an asset in the right structure can be as important as its market price. Most retail investors never think this way. You hold positions, you don't build lattices. That difference in thinking, not in returns, not in intelligence, not in secret information, is one of the more significant structural gaps between how ordinary investors relate to assets and how sophisticated wealth management does. Tax law is not a fixed cost. It is a variable that responds to structure. This is a genuinely important idea, and it's one that most people don't encounter until they're working with wealth advisors, estate attorneys, or tax counsel at a serious level. The same asset held in different structures can produce very different tax outcomes over time. A holding company, a trust, a limited partnership, a charitable vehicle, each one changes how income is recognized, how gains are treated, how assets pass to the next generation. One of the most significant examples is something called step-up in basis. Under current U.S. tax law, and this is a provision that has been discussed for potential reform, when an appreciated asset is inherited, the cost basis can reset to the fair market value at the time of death. This means that gains which accumulated over decades may not be subject to capital gains tax when passed to heirs. The gain existed, it was real, but depending on the structure and the law in place, it may never trigger a tax event in the form most people would expect. This is not evasion, it is planning. It is the use of legal structures available to anyone who has the professional guidance and the asset base to make them functional. Trusts serve multiple purposes in this context, not just estate planning, but asset protection, income splitting, control transfer, and tax deferral. Holding companies can consolidate assets, facilitate borrowing, and provide structural separation between different holdings. What matters to understand is that wealthy families with multi-generational assets often invest seriously in this architecture, in attorneys, accountants, and advisors who specialize in making the structure match the strategy. That investment in structure, over time, can compound just like an investment in a portfolio. Tax law changes, jurisdictions matter. What works today may not work tomorrow. Professional guidance is not optional in this territory. It's essential. There's another dimension to asset retention that doesn't show up in any spreadsheet: control. For certain assets, a significant stake in a private company, a controlling interest in a real estate portfolio, a founding equity position in a business, the economic value is inseparable from the operational and strategic influence that comes with it. When you own a meaningful stake in an operating business, you may have a say in how it's run, who leads it, what it acquires, how it treats its employees and customers. You have access to information, to relationships, to future opportunities that flow through that position. When you sell, you receive cash. You lose the rest. For many wealthy owners, that control premium, the value of influence, access, and optionality that comes with significant ownership, is not something they're willing to convert into cash at any market price. It's simply not the same trade. This is especially true in family-controlled businesses, where the relationship between ownership and operational legacy can span multiple generations. The question is not only about taxes or returns. It's about what kind of position in the world the asset represents, and whether that can be replaced by its sale price. Retail investors rarely face this consideration. When you own 200 shares of a public company, Selling them doesn't affect the company's direction. But at concentrated levels of ownership, the asset and its owner are entangled in a way that makes the sell/hold decision qualitatively different. This is where honest analysis requires a pause. Everything described in this video, borrowing against assets, building collateral lattices, using tax structures to defer gains, depends on conditions that can and do change. Interest rates can rise. When borrowing costs increase sharply, strategies that depend on cheap debt can come under severe pressure. Assets pledged as collateral may face margin calls if their values fall. Cash flows that looked reliable can weaken when economic conditions deteriorate. Tenants vacate. Infrastructure assets face regulatory risk. Private companies face operational risk. Leverage amplifies outcomes in both directions. The structure that works beautifully in a stable environment with moderate rates and appreciating collateral can create serious problems when the environment shifts. History has examples of highly sophisticated owners who faced forced sales at exactly the wrong time because the debt load became unmanageable under changed conditions. Tax law is also not permanent. Step-up in basis has been debated as a reform target. Treatment of carried interest has changed. The rules that make certain structures advantageous today may not look the same in 10 years, and the complexity itself carries risk. Multi-jurisdictional structures, trust arrangements, lending facilities against illiquid assets, these require ongoing professional management. When they're not managed carefully, they can produce outcomes that are worse than simply paying the tax and holding cash. None of this invalidates the logic. It contextualizes it. The never sell instinct that sophisticated owners often carry is not a rule. It's a framework that applies under certain conditions, with certain asset types, at certain scales, and requires serious professional support to execute without breaking. Understanding this doesn't make the framework less interesting. It makes it more honest. Here's what this all adds up to. The wealthy often avoid selling their best assets not because of emotional attachment, not because of arrogance, and not because they have access to some secret financial system that doesn't exist for anyone else. They avoid selling, when they do, because they've asked a different question. Most people ask, what can I sell this for? A different question is, what can this asset keep doing if I keep it? That shift, from price to productivity, from exit to permanence, from realized gain to structural power, changes how assets look. It changes which ones are worth holding, which ones are worth borrowing against, which ones are worth building structure around. It also doesn't apply everywhere. It doesn't apply to every investor, every asset, every situation. It requires scale, professional support, the right asset types, and conditions that reward patience. It carries real risk. It demands active management. It can fail. But the underlying financial logic that a working asset generates income, serves as collateral, defers taxes, and compounds in ways that a pile of post-sale cash cannot replicate, that logic is not exclusive to the wealthy. It's available to anyone who learns to see it. The asset machine doesn't run on wealth. It runs on understanding what assets actually are, not price tags, not exits, machines. And machines are worth more running than sold for parts.